Hey guys, 𝗥𝗲𝗀𝗧𝗧𝗀𝗀 from eToro here, and today we're going to be talking about Alibaba. I've been invested in Alibaba since 2021, and when I began investing in Alibaba, it was insanely cheap, and since I got invested, it's only gotten cheaper. Typically what happens when a stock becomes cheaper is, even though this technically means the stock is becoming better value and less risky, the negativity in the media increases. So while Alibaba is at record value, I'm going to talk about the 5 things that I like about the stock. And again, for the record, as I've already stated, I am already a shareholder in Alibaba, so please take that bias into account. Okay guys, let's get right into it. Now, this is in no particular order, but one of the reasons that I love this stock is its cash pile. 1/3 of their $200 billion market cap is cash, $80 billion of cash. And on top of this, they already have approval from the CCP to use this cash to buy back shares. They'll also be using this cash to issue a dividend. I could go off on one about how a large cash pile or a growing cash pile can demonstrate a really strong competitive advantage, but we're going to be getting into that in the later chapters. And really, I don't think cash should need any explanation. Of course, we love it when companies we are buying have huge cash piles relative to the price of the overall company. So let's just get into number 2, debt. Alibaba have only $20 billion in long-term debt, which relative to their cash pile and relative to their overall equity is pretty much nothing. Again, only companies with an extraordinary competitive advantage and seriously high gross margins are capable of entirely funding their research and development with cash alone. That is how companies like Alibaba manage to have very little long-term debt. Third reason I love this stock is margin of safety. Alibaba have a 70% margin of safety. This is insane. The discounted cash flow model is super simple. It just takes an average of the last 3 to 5 years of free cash flow. Then we apply some reasonable growth expectations to that cash flow over a 10-year period. Free cash flow is the money left after paying for equipment, sales, and products, but before spending it on dividends, interest on loans, and share buybacks. Essentially, free cash flow is the money that shareholders make. Now, of course, we can't predict what it's going to do next year or the year after that, but generally speaking, companies are quite predictable over larger time periods. Now, once we've done this, we get an idea of how much cash we are going to be making over a 10-year period. And of course, we can then assume that we're going to sell the company at the end of the 10-year period. So what we do is we take the free cash flow and we times it by 10. So we're assuming that we're going to be selling the company for 10 times free cash flow. I also want to say that I think for a lot of you, this kind of explains the difference between long-term investors and short-term investors. Most successful investors hold for a period of longer than 5 years, typically 10 years or more. I've had people comment about stocks dropping about 4 or 5% or 10% in a day, a week, a month, a year. To me, this is just noise because I am a long-term investor. I'm sure if your family home was on the stock market every single day of the year, the prices people are willing to pay for it would fluctuate enormously. But just because one day of the year someone is offering you a super low price for it and no one else is showing up doesn't mean that you sell on that day. Now, before we compare the margin of safety from Alibaba to Amazon, I want to explain what the different percentages mean, because a 0% margin of safety means that you are breaking even after a 10-year period. And of course, that does mean that you are losing out adjusted to inflation. But more importantly, we're trying to ignore that sort of noise right now and just trying to work out how we can make the best investment with our money. If the margin of safety is above 0, that means you've lost money. If the margin of safety is below 0, that means you've made money. If the margin of safety is negative 50%, that actually means that you've made 100% on your investment. Or you can think of it the way that I do. If it's negative 50% margin of safety, it means that you are buying it based on your low expectations. You are buying it for 50% less than what it would be worth in 10 years' time. Now, in order for Amazon to have a negative 50% margin of safety, we need to do some pretty dramatic changes to their formula. Now, first we need to take their 5-year average free cash flow and bolster it a lot, because currently that would work out as $10 billion. And actually their last year's free cash flow is $45 billion. Now, a reasonable place to put this that is still somewhat conservative in my opinion is $30 billion. Now, if you invested in Amazon today, in order for them to make your money back in terms of of free cash flow, then they would need a 20% annual growth in free cash flow every year compounded. I also had to lower the discount rate on this growth to 5%. So this is a really big expectation for the stock. It's certainly something that they could do, but basically it means that growth is very, very much priced in. Well, with Alibaba stock, we actually have to lower expectations on the stock in order to hit 50%, because when we leave the stats as they are, it has a 70%, a negative 70% margin of safety. So that is enough about margin of safety. Number 4 is return on assets. The return on assets at Alibaba, similar to Amazon, is really, really low. Now, conventional wisdom would tell you that you want a really high return on assets, right? Because wouldn't you want to buy assets really cheap and make loads of money off those assets? However, having a high return on assets generally means for companies having a lot of competition. As an example, Amazon Web Services is a super profitable part of Amazon. However, because it has such a high return on assets, companies like Google, Microsoft, and even Alibaba have come in to steal their lunch. But where Amazon has very little competition, especially in countries like the US and the UK, is e-commerce. Because while e-commerce does also make billions, it does so with very big, very expensive assets. Imagine trying to build millions of square meters of warehouses across the country, all strategically located to be able to deliver to as many people as possible, versus building a server for cloud computing literally anywhere on the planet. Basically, Alibaba having these huge profits based on low return on assets is what gives me enormous confidence that another company isn't just going to suddenly start eating their lunch. And it helps guarantee this 2.87% growth we need in order to double our money in 10 years. Now, number 5, one of the reasons I am continuing to hold this stock is war with China. You might think it impossible to calculate a war with China, and I would agree with you, but you can do it in relative terms. The question I therefore ask myself is, what do I think is more likely? That Amazon is going to outperform Asia's largest e-commerce and cloud computing business by 15 to 20% annually for 10 years, or the US going to war, even a trade war, with the world's largest producer of solar panels, wind turbines, electric cars, batteries, smartphones, and medical equipment. Of course, this can happen, but I actually think it's more irrational to think that Amazon are going to get this insane growth during a time while interest rates are rising, the same growth that they got as we had record low and dropping interest rates for 10 years into the next 10-year period. A bet on Alibaba is also a bet on this situation between the US and China staying the same, which I think is probably the most likely situation, that we'll still have tensions, but we will still have peace. Historically, peace is the best bet that you can make. And of course, you'll be wrong every now and then, but when you're wrong, everyone is wrong. It's not like Amazon isn't going to be affected by some sort of trade war with China. So I could absolutely be wrong about the China-US situation and its likelihood. However, if I am wrong, then everyone is going to lose. But if I'm right, I am going to win big. And if I am wrong, also, it's only 20% of my portfolio, but yeah, it's not like the remaining stocks in my portfolio won't be affected. For example, I have Volkswagen shares, and one of the biggest customers of Volkswagen cars is China. So don't think that by not buying Chinese companies, you're somehow avoiding that situation. And I know some people will complain about how regulations are done in China. To be honest, as someone that's been doing this a while, it seems that US and UK regulators can be just as frustrating as the CCP. For example, look at how slow US regulators have been to crypto. Anyway, to sum up point number 5, I think that a negative situation with China is unlikely. This is also why I think that Michael Burry, on his latest SEC filings, is massively buying into the stock. Michael Burry has also been selling, he's sold all of his Warner Brothers Discovery shares. I am going to be doing a video about that. Spoiler alert, I think the reason that he's doing that is for tax loss harvesting purposes, so we'll get into my thoughts on Michael Burry's trades in the next video. But the thing that you really need to do if you want to be rich is